So the retirement years are generally segregated into three periods. The go-go years are typically those years right after we retire, when your health is cooperating and you can still pursue an active lifestyle. These are years that are typically characterized by doing a lot of traveling, maybe going to visit the grandkids, playing more golf, or joining the pickleball league and indulging hobbies and interests. Those are the go-go years. Then following the go-go years, we had was characterized as the slow-go years, when we have to reduce these activities, usually because we're slowing down physically, health-wise. We might have some chronic issues that are starting to catch up with us health-wise. And unfortunately, mentally, we're probably starting to slow down a little bit. Okay, the third period after the go-go, slow-go is, no, not much of a stretch here. We're going into the no-go years. And this is a period that is characterized by when our aging dictates that we can no longer do some of the things that we would like to do, what we've been doing in years past. So when I'm coaching clients with respect to what their retirement might look like with regards to healthcare during retirement, the no-go years conversation will often bring up questions about the role of long-term care insurance. I wanted to bring into this conversation a specialist in that field. So I reached out to Jesse Slome. Jesse is the executive director of the American Association for Long-Term Care Insurance. I think I got all that right. That's kind of
You do.
a mouthful there. So, Jesse, can you introduce yourself and share your background in the long-term care space, please?
I love it because I am entering the go-go years, I think.
And I hope that lasts for a long period of time for you.
Hope so too. There's one inevitability, and that's that we all get older every day. So let me give a little bit of background. So yes, several decades ago, at the behest of a bunch of people, long-term care insurance is a very small industry. At the behest of a number of people, I organized a trade organization called the American Association for Long-Term Care Insurance. That was in the 1990s. And our goal is to basically educate, provide meaningful, valuable information to people so that they can better understand what really is a complicated topic, and then provide information and resources. So we don't sell insurance. We're not supported or paid, for by the insurance companies. My opinions are my own, and based on several decades of really focusing on this topic. And let me start. Here's what I'm going to tell.
Okay.
Because I love your definitions. Here's what I'm going to tell anybody who's watching this and deciding, do I stay tuned watching this? The chances of living a long life are increasing, and you're absolutely right. Those are brilliant explanations. Go to slow go to no go. People really understand that. And the issue is, if you live a long life, I'm 70 as you're recording this. I hope to make it. My mom is still alive and turning 98. Wow. If you live a long life, the chances are increasingly high that you're going to need services called long-term care. That just happens because of aging. Sometimes it happens because of accidents or diseases. It could often happen because of dementia or Alzheimer's. But most often it happens to all of us because at age 90, you're just not going to be able to do what you did at age 70. At age 60, you're not able to do what you were able to do at 40. And so you're going to need care called long-term care. The issue is, and the reason for people to watch this and to get an understanding is, people need to understand that when you need this type of care, you're going to have to get it. There's no and, if, ors, or buts. Long-term care insurance is a way that some people get it, but you cannot buy insurance when you need the care. That's a big common misperception of people. You have to really, if you want it as an option, you have to start looking at it in your mid-50s to mid-60s. And so as a result, a lot of people who are in that demographic should stay tuned and should watch this, should understand what their options are, how this, how this works, etc. If you're 80, hey, congratulations, feel free to watch it. But I have to tell you, the insurers won't health underwrite you. Long-term care insurance is really no longer an option for you. There are a few hybrid products that may be available, but generally, this is a topic for insurance, if you're going to focus on insurance, for people who are in their mid-50s, mid-60s, up to about age 70.
Okay. All right. I've known about long-term care insurance for a long time, going back to, late 90s and all. It's evolved. It's changed based on a number of different factors. And consequently, the underwriting process has changed. Some of the things that I've heard is that, well, it becomes more expensive. You get into a policy. I've heard stories of people now, maybe these are urban myths, who knows? But I think there's enough veracity behind it that people have bought into policies and they can't maintain the policies because the premiums are adjusted and they go up and up and up. So over the years, has the insurance industry, I mean, how comfortable should we feel that they know that how to underwrite this? Or are they still in the learning?
Yeah. So a lot of those it's a complicated topic. Let me try and make it simple. So first, yes, long-term care insurance, so we're going to just focus on insurance, has evolved. As I said, I've been around since the late 1980s. In the early years, it was primarily nursing home insurance. People don't want to go to a nursing home. Today, long-term care insurance is what I call nursing home avoidance insurance. So the products have expanded. They now cover nursing home, obviously, but also care in assisted living and home care. Most long-term care insurance policies pay for care in a person's home or in assisted living. Only about a quarter of the benefits paid out are for nursing home care. So one, you hit on the topics. The products today are comprehensive. They cover the spectrum of what people want. If you can afford, if you've saved, if you've built retirement assets, you're going to want to and be able to stay in your own home. That's where insurance comes in. Now, in terms
Can I interrupt you for a second? Because you brought up something about in-home care. So much of the care being provided for our parents are going to be by family members. Do the family members, can they be compensated? Because if I have to make a decision, either I can work and earn an income, or I can take care of mom or dad. Am I going to be in a position where long-term care can help make that decision easier for me?
The answer is maybe. So some policies will allow most, it's this is buying a product. So if you buy, it costs more. If you're paying a family member, insurance companies have learned that it's not that it costs more to pay for the family member, but you're going to access care. You're going to obviously say, hey, son or daughter, here, let me give you this money.
Yeah.
And so policies today are priced based on what the insurance company anticipates paying out. So the short answer is yes, you can find options available today where you can pay family members. Most of the policies require you to pay a licensed home care provider, and that's the insurance company. One looks and says that's for the benefit of the recipient, and two, so that you're not just hey, buying insurance and hey, son or daughter, here's a way for you to make $3,000 a month. Come in and check on me. So but yes, you can get what you want today. Okay.
And I'm sorry I interrupted you.
So let's go back to, because you're absolutely right. Rates. So I've got good news. We just literally this morning released some information on long-term care insurance products for 2023. And the prices in 2023 are lower than they were in 2022. And you go, why is that?
Right.
Well, the answer is
I know.
These products are very interest rate sensitive.
Yeah.
So products issued in the 1990s, which is the ones that you're hearing today about getting rate increases, Products issued in the 1990s, the insurance companies assumed that about half of the money that they wanted or needed to take in to pay future claims would come from premiums, what people write as a check.
Right.
Half would come from the investment of those premiums over, say, 20 years. Well, when interest rates went down to zero, the insurance companies weren't making the returns that they wanted. And at the same time, more people were going on claim. People were not dropping this coverage, they kept it. So bottom line is the older policies, the insurance companies had to go back in and file for rate increases. Today, you're not in a zero interest rate environment. In fact, quite the opposite. Yeah. So I look and go, first, prices for new policies today are cheaper than the old policies. And secondly, if we stay in this interest rate environment, and neither you nor I can predict the future, there's really almost, the insurance companies are using better assumptions to price this, and I won't make this an actuarial lecture, but I could look you and anybody in the eye today and say, if you're buying a new policy today, you face very little risk of a future rate increase. If you buy a linked benefit product, which is a life insurance policy, then those policies are structured so that there's no risk. But on the traditional policies, what I like to say is the past doesn't equal the present or the future. But it's a complex topic.
So you're saying if you got a long-term care this year, rates would not go up in the future, regardless of how long you have it?
If you buy,
there's always that risk, right?
Well, if you buy a linked benefit product, some of those have absolute guarantees. Okay. If you buy a traditional product, there are no guarantees, but you have to look and you have to understand. First, the states don't like approving rate increases, so they've put more restrictive requirements on the insurers. So there's a very, the products today are priced very differently. For anybody who's an engineer and a financial wants to peel back the onion. So 10, 20 years ago, the insurance companies factored in, and they really didn't have experience, they factored in that annually about 4% of policyholders would drop their coverage, just voluntarily drop. Mm-hmm. Involuntary drop means you're dead. But a voluntary drop means, I'm canceling this, I made a mistake, I don't want to buy it. Well, if you think about it, you're Genworth, John Hancock, any one of the big companies, you sold 100,000 policies that year. 4% are going to drop annually, but you don't expect claims to come in for about 20 years as people age. At the end of 20 years, 20 times 4 is 80. So now, of those 100,000 policies, 80,000 have dropped off. You now only have 20,000 remaining that you're going to potentially pay claims on. About a third to a half of those will go on claim. That's the reality. So, but what really happened is, and they just didn't have this kind of experience, only 1% people bought this coverage, and they made a really conscious understanding of the fact that they, people who buy this insurance are planners, they're warriors, they're financially able to afford this, and they understand the way insurance works. Only 1%, and in most cases it was actually a little lower than 1%, dropped their coverage annually. At the end of those 20 years, instead of 20,000 policyholders, you now have 80,000 policyholders. There's still half to a third go on claim. Yeah. That's where the insurance companies got hit. Today, the new policies, that's why they're much more expensive when you buy them now. The new policies are priced assuming that 1% or even lower than 1% will drop their coverage. So, if I'm here in 20 years, you can come back to me and say, you were wrong or you were right. But I would tell somebody who's watching this, and actuaries have done studies of it, that there's really very little risk if you're buying a traditional policy of future rate increases. That's sort of been factored in. And the fact, if we have 20 years of interest rates where we're at today, 5-6%, then you probably won't face that.
All right, I want to
But
talk
I'll
about.
end with this. I'll end with this too, because I just literally took a call from a woman who was 83. The people who were subject to rate increases, it's not like the insurance company rips them off. People pay more. We fill our gasoline tank. I'm in California. Gas is back over $5 a gallon. Things cost more. We understand that. And nobody likes paying more, but those are the realities. When an insurance company raises rates on an older policy, they give people options. They say, look, you can change your benefit package. Maybe you bought a lot of insurance, you bought a very rich plan, you can cut it down. You can change the inflation growth factor. Or they'll give you what's called basically a non-forfeiture, which means you paid in $50,000. You paid us $50,000 over the past 20 years. You haven't lost that money. If you want to stop paying altogether, you'll have $50,000 of potential long-term care benefits available to you. You still have to qualify, you have to meet all those qualifications, but if you need long-term care, we're going to pay you out to $50,000. So, it's not people, as I look how much time we've taken just discussing this. Yep. The insurance companies are not ripping people off. They're paying claims. On our website, we report every year. Last year, they paid over 300,000 people and something like 12 or 13 billion dollars in claim benefits, and it's up every year. So they're doing their job.
So, how many insurance companies, are players in this field now? Hasn't that field shrunk over the years?
Yeah. Oh yeah.
Isn't that kind of bad then, because you don't have as many people competing, or is it all dictated by underwriting?
No, it's not. It's not dictated by underwriting. It's dictated by profitability and where can you make the most money and mergers. So at one point you had about 70 different companies, and I categorize it. You'll read numbers that are higher, but there's a John Hancock of New York, a John Hancock of Wisconsin, because sometimes the companies, and that to me is John Hancock.
Right.
A lot of the companies looked and said, this is a small business. It's a risky and expensive business. It's a tough one to be in. So they still service their policies, but they've stopped offering new policies. There are about 8 or 9, 10 maybe companies that still offer traditional. There are far more companies today that offer the linked benefit products, which are the life insurance products. And as interest rates go up, I think you're going to see more annuity companies coming in and starting to offer annuities that can pay. So it's a constant, it's economics. You used to have 100 airlines. Today, you've got what? 10 major airlines, and nobody would say that, hey, air travel is dead. We're going back to horses.
Okay, so let's talk a little bit about the typical benefit and how that would be priced for a typical. Maybe there isn't a typical premium that you would pay, but what, generically, is there something we could point to and say, okay, this is what you ought to think about? You're going to spend. How long is it assumed that someone would be in a long-term care situation? How many months is that? Like 18 months, or what is it? I know it's going to average. Nobody ages at the same pace, so it's going to be different.
You're a financial planner, and so I'll answer it this way. Averages are meaningless. Okay. To anybody watching this, because if you need no long-term care and I need 6 years of long-term care, the average is 3 years. For you wasted your money because you didn't need long-term care. For me, I bought a policy that only paid half, of the term that I needed it. So this is not something you should look at in terms of averages, because the averages are truly meaningless. An individual's risk, first of all, is, will they need long-term care or won't they? And there it's either 0 or 100. Now you decide. The second decision is, okay, if I need long-term care, what am I going to do? How much money do I have? And more importantly, am I willing to spend? You know, when you get to those slow go and no go years, my grandmother used to, hold her fists, and she used to go, we hang on to everything, and she's right. Because you remember, my first job, I think, paid me $1.35 an hour. And today, if I needed someone to come into my house just to sit there and make me a sandwich for lunch, I'm going to pay anywhere from $25 to $40 an hour for a homemaker to come in. So people look, as you get older, and you look and you go, that's outrageous. I'm not going to do it. I'm not going to spend it. So what do people do? First, they turn their families. You can, if you're married, you look right now, and if you're married at 60, you're assuming you're going to be still married at 80, and the chances are you're not. One of you might be alive, but chances of both people are rare. So, you're making a whole lot of wrong assumptions. The issue is most people are going to do one of the following. They're going to turn a loved one, a spouse, or somebody into their caregiver, or they're going to start to rely on their adult children, and they're going to disrupt their adult children's lives.
Yep.
They don't want to do that, but that's what's going to happen. And they're not going to go willingly to pay for outside services. So the first thing I tell a consumer is, okay, look at your investments, your retirement portfolio. Talk to someone like you and understand the dollars and also your psychology. Some people will look and say, look, I've got 2, 3, 5, it doesn't matter how much money they have. If I need care, I'm going to get it. When I need a gardener, I hire a gardener. When I need a pool, I live in California, I do my own gardening, I do my own pool. In a neighborhood where nobody does their own gardening in their own pool.
Right.
I'm frugal. I'm going to be the last person that's going to go out and hire a caregiver if I have to pay out of my own pocket. So understand who you are and how much money you have and your family situation. And then if you look and say, okay, you know what? I understand. Now, then you can start to have the insurance discussion. First, you have to start having that discussion, as I said, in your 50s and 60s, when you can health qualify. You brought up health underwriting. I'll answer that in a second, because that really is the most important thing. All of these other topics are meaningless to anybody watching this. You're going to spend hours thinking, what should I do? What should I do? The first thing is can you even qualify for insurance? And the insurance companies are, as I said, they pay out billions of dollars a year, but they're not looking to lose money on a product. They're not in this as, goodwill. So they have learned over the past 20 and 30 years what conditions do we now have at age 60? What medications are we taking at age 60 that will keep us alive until 80 and 90, but very likely bring us to a point where we're going to need care? And so once you start hitting your after age 60, so two things happen after age 65. This is why I call 65 the magic number. Two things happen. First, you get a Medicare card. And the Medicare card, while people grouse and look and grumble, Medicare is a great program, because whether you have Medicare Advantage or Medicare Supplement, you now basically have universal insurance. In a country that doesn't believe in socialized medicine, ask any senior who's on Medicare and they'll tell you, I love it. And it's true. I can go to any doctor, I can get a second opinion. I'm going for this treatment, I'm going for that treatment, I'm going for all kinds of treatments because I want to stay young. All of those, every time a doctor prescribes a new medication for you, okay, every time you get a new different treatment, I'm now going, they think, oh, maybe I need a hip replacement. I need a back. I'm going for MRIs, and I'm still mobile. I do my own gardening in my pool. I said, but I got an ache and a pain here. Why not go? They write it down into the records. Those records are shared. The insurance companies look at those records. Most people manage their health care until they go on Medicare. And then they start going for their physicals and they start visiting doctors aplenty. All of those things are the things that are going to have an insurance company preclude you from getting long-term care insurance if you're obese. The guidelines, the underwriting guideline for some of these insurance companies are pages. There might be 10, 15 pages, single-spaced, of drugs. If you take these drugs, you're either not insurable, or if you take this drug and this drug, you're not insurable. They are truly looking for healthy people. After age 65, 70, the insurance companies turn down about 40% of the people that apply.
Wow.
That's people who apply. So the first question is, can you get this? That should be the point that a consumer looks at. Then they really have to just sit down and say, okay, what does this insurance cost? So we publish a price index. It's on the association website. And we give prices for 55, 60, and 65-year-olds. Here's what I'm going to tell people based on a long time talking to a lot of people in this business. When it comes to long-term care insurance, some coverage is always better than no coverage. And the reason that I say that goes back to my examples, back to that home care worker, or back to an assisted living facility. Let's use assisted living. Well, here in Southern California, if I needed care in an assisted living facility, I'm going to find one down the street that's $9,000 a month. I'm going to find one 30 miles away that's $6,000 a month. If I have to pay out of my own pocket, I'm very likely to pick the one that's $6,000 because that's a lot of money. But now my spouse has to drive there. She can't visit on a daily basis. It's a grind. If I have some insurance that picks up some of the cost, I'm going to pick the more expensive one. It becomes like a coupon. Same thing for home care. So when you're looking at long-term care insurance, people too often have been told, oh, here's the answer. Everybody buys a $150 a day, the 5% inflation protection, 3 years, because that's the average. And then people either look and they smile at you as a planner and they go, oh, that's very nice, I'll get back to you. And they don't do anything. They have no coverage. They're not going to tell you, gee, that's too expensive. Can you show me something cheaper? Because I'm a cheapskate, So these policies are extremely flexible. And that's what we show on the price index that we post. You could buy a policy today that has no inflation growth. You could buy a policy that has 1%, 2%. And when inflation was low, that might have been enough. You can find some that have 3% or 5%. So you really, it's sitting down and figuring out. But at the end of the day, having something is better than nothing. You'll access care sooner. You'll have more options. You won't turn your loved ones into your caregivers.